Have you ever wondered how some traders turn a tiny $100 into thousands, while others blow their accounts in days? The truth is, it's not about luck or having a huge bank balance. It's about mindset, discipline, and knowing exactly what to do with what you have. This video is for anyone who's ever thought trading was too complicated, too risky, or too big players only. I'll show you how a small trader, starting with just 100, can build confidence, master the market, and grow consistently. No jargon, no fluff, just real strategies, real psychology, and real stories that you can relate to. By the end of this video, you'll understand the mindset of successful traders, the habits that make them consistent, and the actionable steps to start your journey, even if your trading account is tiny. Because in trading, it's not how much money you start with, it's how smartly you use it. Chapter 1. Start small, think big. When most people think about trading, they imagine giant screens, fancy software, and piles of money being thrown around in seconds. They think you need thousands, if not tens of thousands, to even have a chance of making real profits. But the truth is far from that. Some of the most successful traders in the world started with less than $100 in their accounts. And the lesson they learned, and you will too, is that it's not the size of your starting capital that matters. It's the mindset you bring into the market and the discipline you build along the way. Imagine a young trader named Alex. He opened his first trading account with just $100. To his friends, it seemed almost laughable. Why even bother? They asked. But Alex didn't need their approval. He knew that $100 could teach him lessons that a $10,000 account could not. Every cent mattered. Every decision required thought, patience, and a clear strategy. And it's exactly this focus, this deliberate care, that laid the foundation for him to grow, not just his account, but his confidence and trading skills. Starting small forces you to develop skills, not rely on luck. When you trade with a huge account, mistakes can be hidden by the sheer size of your capital. But with $100, a single mistake can teach you lessons that no book, no mentor, and no webinar ever could. It teaches respect for the market. It teaches risk awareness. And most importantly, it teaches patience. Traders who start small learn to value consistency over impulsive gains. They learn that making $5 today and $7 tomorrow, compounded consistently, can outperform a $500 win that disappears in a single bad trade. One of the most common mistakes beginner traders make is overestimating what their money can do for them and underestimating what they can do with their money. They assume that if they just deposit more, they'll make more. But trading isn't about throwing money at a problem. It's about creating a system, a strategy, and a mindset that can survive and thrive under pressure. Starting with $100 forces you to focus on what truly matters. Process over outcome. When your trades are measured, your decisions deliberate, and your risk controlled, growth becomes inevitable. Think about everyday life for a moment. If you were learning a new language, you wouldn't expect to speak fluently after just 1 week of practice. You'd start with small lessons, daily repetition, and a commitment to improvement. Trading is exactly the same. Your $100 account is your classroom. Each trade is a lesson, each loss is feedback, and each small win is proof that your methods work. Treat your account as an experiment in learning, not a gambling machine. Take Sarah, for example. She started with $100 and decided she would only risk $2 per trade. Many of her friends scoffed at the tiny profits she was making. But she kept a trading journal, analyzed every trade, and focused on learning from mistakes instead of chasing instant riches. Within 6 months, her account had grown to $1,000. Not because she got lucky, but because she learned the rules of the game, disciplined herself, and let compounding work quietly in her favor. Sarah's story is proof that starting small doesn't limit your potential. It magnifies it. Another important aspect of starting small is understanding risk. Every trade carries the possibility of loss. If you risk too much at the start, you can wipe out your account in hours. leaving frustration, doubt, and fear in your wake. But when you start with a manageable sum, losses become lessons, not catastrophes. You learn to respect stop losses, to size positions properly, and to make decisions that protect your capital. This principle is not just for trading, it's a life lesson in financial responsibility, patience, and careful planning. Let's also talk about mindset. Many traders fail before they even begin because they are overwhelmed by the illusion of needing big money. They think $100 isn't enough to make a difference. But this mindset creates paralysis. You feel stuck, anxious, and afraid to start. The truth is, a small account eliminates excuses. It forces action. It forces creativity. It forces discipline. You learn to adapt and innovate. Every trading decision matters more, which accelerates your growth as a trader. One key habit of successful small traders is journaling. Every trade, every thought, every emotion should be recorded. This simple habit builds self-awareness and reveals patterns you would never notice otherwise. Did you panic because of a losing trade? Did you enter too early because of greed? These insights, captured in a journal, are worth more than any expensive trading course. And the smaller your account, the more impactful this practice becomes. Another lesson from starting small is learning to set achievable goals. You may start by aiming to grow $100 to $150 in a month. That might seem tiny, but in trading, small wins matter more than massive gains achieved through reckless risk. These small goals are repeatable, measurable, and scalable. They help build confidence while reinforcing disciplined behavior. Once you master consistent small wins, scaling becomes natural. You learn to compound your growth safely without succumbing to emotional mistakes. It's also important to embrace the fear that comes with small accounts. Fear is a natural response to risk, but it can be a teacher rather than a barrier. A $100 account can make fear tangible. When you feel fear, you learn to control it instead of letting it control you. You learn to trade with a plan, respect your limits, and avoid impulsive decisions. In contrast, traders with large accounts often ignore fear, which leads to overconfidence and eventually catastrophic losses. Fear, when managed properly, becomes a tool that sharpens your edge. Lastly, starting small teaches gratitude and humility. Every win, no matter how minor, feels significant. Every lesson learned feels like progress. And when your account grows over time, the satisfaction isn't just financial. It's emotional. You gain confidence in your skills, trust in your discipline, and respect for the market. These lessons are lifelong. They will stay with you whether your account is $100, 1,000, or 100,000. So, as you begin this journey, remember this. It's not the size of your starting capital that defines you as a trader. It's the mindset, discipline, and consistency you bring to the table. Starting small is not a limitation. It's a superpower. It allows you to make mistakes without devastation, learn lessons without fear, and grow in ways that large accounts often obscure. In this chapter, we've explored why small beginnings matter, how $100 can teach you more than $10,000, and why the lessons of discipline, patience, and process are priceless. The next time you sit in front of your screen, remember Alex, Sarah, and countless other traders who started with less than you have now and turned it into something extraordinary. Take that first step, focus on learning, and think big. Because the $100 trader who starts today could be tomorrow. Chapter 2. The Psychology. Edge trading is not just numbers and charts. Most traders will tell you that the market is unpredictable, volatile, and risky. But the real battle isn't out there on the charts. It's inside your head. The biggest account destroyer isn't a sudden market crash or a technical glitch. It's your own emotions. Fear, greed, overconfidence, and impatience quietly creep in and sabotage even the smartest strategies. If you want to be a successful $100 trader, understanding your psychology is just as important, if not more, than understanding candles, indicators, or chart patterns. Let me tell you about Mark, a trader who started with $100. Mark had studied the markets for months, read every book he could find, and even practiced on demo accounts. He thought he was ready. But the first day he traded real money, panic set in the moment the price went slightly against him. His hands shook, his heart raced, and without thinking, he exited a perfectly fine trade, taking a small loss that could have been avoided. That was the day he realized that understanding the market is one thing, but mastering your mind is a completely different challenge. Fear is the most common emotion that kills new traders. It manifests as hesitation, overreacting to small losses, or avoiding trades entirely. When fear dominates your decisions, you second-guess your strategy, miss opportunities, and slowly erode confidence. Fear is particularly strong when trading small accounts like $100, because every dollar feels precious. But here's the paradox. A small account can actually be the best teacher. When fear is present, it forces you to develop discipline and control. You learn to step back, assess risk rationally, and remind yourself that a single loss is just one part of a bigger journey. Greed is the other side of the coin. It appears subtly, often disguised as ambition or the desire to make up for losses. Hurry! Many traders make the mistake of chasing profits, adding extra risk, or increasing their position size impulsively. Sarah, another trader, once had a small $100 account. After a week of consistent gains, she thought she was invincible. She entered a trade with twice her usual risk, thinking the market owed her a profit. Within minutes, she lost almost half of her account. That moment taught her one of the most valuable lessons in trading. Greed is never satisfied, and it often destroys what took weeks or months to build. Overconfidence is equally dangerous. When a trader starts winning, it's easy to assume that every decision is correct, that the market will bend to their will, or that they are smarter than everyone else. But the market doesn't care about your ego. Even the best traders lose trades. The difference between successful and failed traders is not avoiding losses entirely. It's controlling how you respond to them. A $100 trader who wins 2 trades in a row and then risks recklessly is more likely to wipe out their account than a beginner who accepts small losses calmly and moves on. Impatience is another silent killer. The market doesn't move according to our schedule, and waiting for the right setup is often harder than entering trades impulsively. Imagine a trader staring at their screen, seeing small fluctuations, and feeling the urge to act immediately. Acting without patience often leads to entering trades at the wrong moment, cutting profits short, or compounding losses. Learning to wait, observing market behavior, and following a well-defined plan separates disciplined traders from gamblers. So, how do you gain the psychology edge? First, acknowledge that emotions are natural. Trading is a human activity, and being human means feeling fear, greed, and impatience. The goal isn't to eliminate emotions, it's to manage them. One of the most effective methods is journaling. Write down every trade, every decision, and the emotions you felt. Were you scared when you entered a trade? Did greed make you hold too long? Did impatience make you exit too early? By recording and reviewing these experiences, you begin to recognize patterns in your behavior and learn to control them. Visualization is another powerful tool. Before entering a trade, imagine different scenarios: winning, losing, or even seeing the market move against you temporarily. This mental rehearsal helps reduce panic and allows you to stay calm under pressure. Traders who practice visualization often find that their reactions become more measured and rational, even when the market behaves unpredictably. Discipline routines are essential. Simple habits like defining your daily risk limit, sticking to a trading plan, and taking scheduled breaks can drastically reduce emotional decision-making. Take Alex, for example. He created a routine where he would only trade between 9:30 and 11:30 a.m., strictly following pre-planned entry and exit points. If he missed a trade setup, he didn't chase it. This discipline not only protected his A $100 account, but also built confidence and consistency, allowing him to grow slowly but steadily. Another practical tip is focusing on process, not outcome. Many traders obsess over profit, losing sight of the quality of their decisions. A $100 trader should aim to execute trades correctly, manage risk, and follow strategy meticulously. If the process is solid, profits will follow. If the process is ignored, even a lucky streak can vanish in a single impulsive trade. Real-life scenarios also help anchor lessons. Consider Lisa, who started with $100. She once experienced a sudden spike in a stock that she thought would skyrocket. Her fear of missing out, FOMO, took over, and she jumped in without analyzing the setup. The trade went against her, and she lost $30, almost a third of her account. That loss was painful, but it became a turning point. She realized that mastering her psychology, managing FOMO, staying patient, and trusting her plan was more valuable than any technical strategy. After implementing these lessons, she never repeated that mistake and gradually grew her account consistently. Understanding the psychology edge also involves accepting losses. Losses are inevitable in trading. Even the best traders experience them. The difference lies in how you handle them. A $100 trader who panics and tries to recover losses quickly risks blowing up their account. A trader who accepts losses calmly, reviews the mistakes, and moves on grows stronger with every setback. Losses are feedback, not failure. Finally, it's about self-awareness. Successful traders spend as much time studying themselves as they do studying the market. They recognize emotional triggers, know when to step away, and understand their limits. Developing self-awareness is like sharpening a sword. It makes every trade more precise and reduces unnecessary risk. A $100 trader with high self-awareness can survive volatile markets, remain consistent, and slowly turn small gains into meaningful growth. In essence, the psychology edge is the secret weapon of small traders. While everyone else is chasing charts, indicators, or perfect strategies, the disciplined trader focuses on mastering their mind. Fear, greed, overconfidence, impatience, and FOMO will always exist, but by managing them, you gain an edge that money alone cannot buy. Starting with $100, this edge is amplified. You cannot afford emotional mistakes, so you must learn control quickly. And those who master it find that trading is not just about money. It's about personal growth, self-discipline, and mental resilience. By understanding and applying these psychological principles, you will see a shift not only in your trading performance, but also in your confidence. The $100 trader who conquers their emotions becomes a trader who can survive any market, handle losses gracefully, and grow consistently over time. Mastering your mind is not optional. It is the foundation upon which every successful trade, every account, and every career in trading is built. Chapter 3. Smart Money. Rules trading is exciting. The charts light up, the markets move, and every trade feels like a chance to change your life. But without smart money management, excitement can quickly turn into disaster. Most traders fail, not because their strategy is bad, but because they ignore the most important principle in trading: protecting what you have. A $100 account can teach this lesson better than a $10,000 account, because every dollar counts. Learning to manage your money wisely isn't optional. It's the difference between survival and getting wiped out. Let me tell you a story about David. David started trading with 100, fueled by optimism and dreams of turning it into $10,000 quickly. On his first day, he risked $50 on a single trade because he thought it was a sure thing. The trade went against him, and half of his account vanished in minutes. Devastated, David realized the market wasn't a place for heroics. It was a place for discipline. He had learned a lesson most traders take years to understand. Never risk more than you can afford to lose, and always protect your capital. That $100 wasn't just money, it was a teacher. The first rule of smart money management is position sizing. How much money you put on a single trade determines how long you can survive in the market. For a small account, position sizing is everything. Many beginners ignore this and go all in on trades that feel promising. But trading isn't a lottery ticket, it's a skill. By risking only 1 out of 2% of your account per trade, you ensure that no single loss can destroy your progress. For a $100 account, that means risking just $1 or $2 per trade. It might feel slow, even frustrating, but this restraint is what allows small accounts to grow steadily. Slow growth teaches patience, discipline, and the value of compounding. Risk-reward ratio is the second principle. A trader may have a winning strategy, but if they don't understand how much they can lose versus how much they can gain, even winning trades can become unprofitable. Imagine a trade where you risk $10 to make $8. Even if you win 60% of your trades, you will eventually lose money. Smart traders focus on setups where the potential reward outweighs the risk, ideally at least 2.1 for a $100 account. This mindset ensures that each small gain is meaningful, compounding into larger profits over time. Let's talk about losses, because every trader experiences them. Losses aren't failures, they are feedback. When John started trading with $100, every loss felt catastrophic. One day, after losing $5 on a trade, he wanted to make it back immediately and over-leveraged on the next trade. Within an hour, he lost another $10. That was when he realized that chasing losses is the fastest way to destroy your account. Smart money management teaches you to accept small losses, learn from them, and move on. Controlling losses is just as important as making gains. Another essential rule is protecting profits. Even small accounts can grow quickly if profits are managed wisely. For instance, if you turn $100 into $120, some traders would risk the entire $20 gain on the next trade. That's risky and unnecessary. Instead, a smart trader secures profits, maybe by withdrawing a small portion or by adjusting stop-loss levels to lock in gains. This habit ensures that growth is sustainable and that emotions don't tempt you into reckless decisions. Capital allocation is also a key factor. Beginners often scatter their money across too many trades, thinking more trades equal more opportunity. But in reality, spreading your account too thin reduces focus and increases risk. Trading isn't about doing more, it's about doing smart. A $100 trader might take only 1 or 2 trades at a time, ensuring each trade is carefully planned and executed. This approach builds discipline and keeps emotional stress manageable. The story of Emily illustrates this perfectly. Emily had a $100 account and decided to trade multiple small stocks at once. She lost track of her positions and made impulsive decisions. Eventually, her account shrank to $70. Frustrated, she switched her approach, taking one high-quality trade per day, sizing it properly, and sticking to her plan. Within weeks, her account not only recovered but grew consistently. This demonstrates that fewer, smarter trades beat many random trades every time. Risk management isn't just about numbers, it's also about mindset. You need to train your mind to accept that losses are part of trading and that the goal is survival first. If you can protect your capital, you can keep trading another day. This mentality is what separates small, consistent traders from those who blow up their accounts chasing unrealistic profits. A $100 trader who masters this mindset has a huge advantage over traders with bigger accounts but poor control. One of the most powerful tools a small trader can use is a trading plan. This plan outlines how much you risk per trade, what setups you will take, how you calculate risk-reward, and how you handle profits and losses. It removes guesswork, reduces emotional trading, and ensures every decision is aligned with your goals. Writing a plan is easy, but following it consistently is where most traders fail. Discipline here translates directly into growth. Let's consider compounding. It might sound boring compared to the excitement of big trades, but compounding is the secret weapon of small accounts. By risking small percentages, controlling losses and securing profits, even a $100 account can grow exponentially over time. For example, a consistent 5% monthly gain may seem small, but after a year, it can nearly double your account. Traders who chase huge gains often miss this, exposing themselves to large drawdowns and emotional stress. Patience, discipline, and smart money management create results that feel almost effortless in hindsight. Technology can also help. Using stop losses, alerts, and trading software ensures that your trades are protected even when emotions might tempt you to override your plan. For a $100 account, this is critical. Every trade must count, and automation can be a safeguard against human error. Small traders who embrace technology wisely often outperform larger, less disciplined accounts. Another important principle is avoiding overtrading. Small accounts tempt traders to trade constantly, hoping for a miracle gain. But more trades mean more exposure and more mistakes. Trading selectively, focusing on high-quality setups, and sizing positions properly ensures that your account grows steadily without unnecessary stress. Overtrading is the silent killer of small accounts, while disciplined traders protect their capital and patience. Even lifestyle habits affect money management. Sleep, nutrition, and mental state influence decision-making. A tired or stressed trader is more likely to over-leverage, chase losses, or make impulsive trades. Taking care of your mind and body is part of protecting your capital. This may seem unrelated to smart money rules, but the best traders know that their behavior outside the market directly impacts results inside the market. Finally, the most valuable lesson of this chapter is that smart money rules are life rules. They teach patience, discipline, responsibility, and respect for risk. A $100 account may seem small, but it magnifies these lessons in ways that bigger accounts often obscure. By controlling risk, protecting profits, sizing positions, and following a plan, a trader develops habits that ensure long-term success, not just in trading, but in financial decisions, career planning, and personal growth. David, Sarah, Emily, and countless other small traders have shown that starting with a small account isn't a limitation. It's an opportunity. It forces you to focus on what matters most: survival, discipline, and consistent growth. Every lesson you learn while managing a small account compounds, just like your profits eventually will. The $100 trader who masters these money rules doesn't just trade. He or she builds a mindset, a system, and habits that create lifelong success. In the end, smart money management isn't a complicated formula. It's a mindset, a set of habits, and a strategy to protect what you have while slowly growing it. A small account magnifies the importance of each decision, making lessons unforgettable. By the time your $100 account grows to $1,000 or more, you won't just have money. You'll have skill, discipline, and confidence. And that is what separates a hobby. Chapter 4. Master the charts. Charts are the language of the market. To many new traders, they look like a confusing wall of lines, candles, and numbers, almost like trying to read a foreign language. But the truth is, charts are far simpler than most people think. They don't exist to confuse you. They exist to communicate what the market is thinking. Every spike, every dip, every pattern tells a story. And as a $100 trader, learning to read that story is one of the fastest ways to grow your account without risking unnecessary money. I remember when Jason started trading with his first $100. He opened a chart and froze. What do all these candles mean? He asked himself. Red, green, lines, wicks. It felt like a puzzle designed to trap him. But slowly, he learned that each candle represents a decision, a moment in time where buyers and sellers collided. Understanding that simple idea changed everything for him. Instead of guessing, he started observing. He noticed patterns repeating, trends forming, and levels where the price always reacted. That small insight was the first step to mastering the charts. One of the most important lessons for small traders is that charts are not about perfection. They're about probability. You don't need to predict the market 100% accurately. You need to spot areas where the odds are in your favor and take trades that respect your risk rules. Patterns like support and resistance, trend lines, and simple candlestick formations are all tools to help you make these probability-based decisions. For a $100 account, this mindset is crucial because every trade must matter and losing trades must be controlled. Let's talk about support and resistance, one of the most basic yet powerful concepts in trading. Imagine the price of a stock keeps bouncing off a certain level. It's as if the market says, "This is too cheap to go lower," or "This is too expensive to go higher." These are your support and resistance levels. Anna, a $100 trader, learned to mark these levels on her charts. One day, the price approached a strong support zone. Instead of panicking as it dipped slightly below, she waited and watched for confirmation. When the price bounced back, she entered a trade with a clear plan, risking only a small portion of her account. That trade didn't just earn her money, it taught her the power of patience and observation. Trend lines are another essential tool. A trend line is simply a line that connects higher lows in an uptrend or lower highs in a downtrend. Many beginners overcomplicate trend lines, drawing dozens of lines across the chart and getting lost. The truth is, you only need a few clear lines to identify the direction of the market. Once you see the trend, you can align your trades with it. Trading with the trend increases your probability of success. And for a $100 account, this is life-changing because it minimizes unnecessary risk. Candlestick patterns are often overhyped, but when understood simply, they become powerful signals. A bullish engulfing candle, a hammer, or a shooting star is nothing more than a visual representation of market sentiment. When a $100 trader sees a hammer forming at a support level, it's not magic. It's evidence that buyers are stepping in. Combined with your risk management rules, these signals can help you enter high-probability trades confidently. Another crucial lesson is the importance of time frame selection. Small accounts don't need to chase every tiny movement. Jason learned that trading on overly short time frames made him impatient, emotional, and prone to overtrading. By switching to slightly longer time frames, he could filter out noise and focus on meaningful patterns. For a $100 account, this approach reduces mistakes and allows you to focus on quality setups rather than quantity. Indicators can also be useful, but only when used correctly. Beginners often pile on dozens of indicators, hoping for a magic signal. The truth is, indicators lag, and too many can create confusion. For a small trader, simplicity wins. A moving average to identify trend direction, or a basic RSI to spot overbought or oversold conditions is often enough. Anna found that using one or two indicators alongside her support and resistance levels gave her a clear edge without cluttering her charts. Real examples make these lessons stick. Consider a trade Anna took recently. She identified a strong resistance zone where the price had previously failed to break above multiple times. She noticed a bearish engulfing candle forming right at that level. Instead of rushing in, she waited for the next candle to confirm weakness. Her patience paid off. The price dropped, and she made a small but consistent profit. That trade illustrates everything: understanding patterns, respecting levels, and exercising patience. Small trades like this, repeated consistently, compound over time. Another common mistake beginners make is overanalyzing. You don't need to predict every tick of the market. Charts are tools to make decisions based on probability, not certainty. Overthinking leads to hesitation, missed opportunities, or worse, impulsive trades. A $100 account can't afford hesitation or impulsive behavior. The goal is clarity. Identify patterns, respect your rules, and execute with confidence. Journaling your chart analysis is just as important as studying the charts themselves. Jason started noting down why he took each trade, which patterns he saw, and whether his analysis was correct. Over time, he could review past trades and identify recurring mistakes, such as misreading support zones or entering too early. This habit turned his $100 account into a learning machine, accelerating his growth faster than any course or mentor could. The psychology of chart reading also plays a huge role. Many traders see a pattern forming, get excited, and enter impulsively. But the chart is a tool, not a crystal ball. Waiting for confirmation is often the difference between a winning trade and a losing one. Even with a small account, exercising patience and controlling emotions allows trades to play out in your favor. Let's talk about risk management in the context of charts. Spotting a pattern is meaningless if you risk too much on it. A $100 trader might see a perfect setup, but must still calculate stop-loss levels, position size, and potential reward. Combining chart knowledge with money management ensures that even when trades don't go as planned, your account survives and grows steadily. This is the edge that separates disciplined traders from gamblers. Charts also teach discipline. Every line drawn, every candle analyzed, and every pattern identified reinforces structured thinking. Small traders who follow a routine of analyzing charts daily develop patience, focus, and confidence. They learn to wait for high-probability setups and resist the temptation to chase the market. This mindset is transferable to other areas of life: disciplined observation, patience, and strategic decision-making. Another story illustrates this perfectly. Maria, a $100 trader, used to get frustrated when her trades didn't work out immediately. She would jump from one chart to another, constantly seeking action. Eventually, she started focusing on one chart each day, marking key support and resistance zones, and waiting for proper confirmation. Her results improved dramatically. She realized that mastering charts isn't about speed, it's about clarity, focus, and consistency. It's also important to embrace mistakes as part of the learning process. Misreading a pattern, entering too early, or exiting too late is inevitable. The $100 account magnifies these lessons, forcing you to internalize them faster. Over time, repeated exposure to charts and patterns builds intuition. You start to feel the market, recognize setups without overthinking, and make decisions with confidence. Charts can also reveal market psychology. Every price movement reflects the decisions of thousands of traders. By observing trends, reversals, and patterns, you are essentially reading collective behavior. A hammer candle at support shows buyers stepping in. A breakout above resistance signals confidence. Understanding these psychological cues is just as valuable as technical rules. It teaches you to anticipate market moves rather than react blindly. Finally, mastering charts is not about complexity. It's about simplicity, observation, and discipline. You don't need dozens of indicators or complicated formulas. You need to see patterns clearly, understand market behavior, respect your risk rules, and stay patient. Small traders who master this skill can turn even a $100 account into a powerful learning tool, laying the foundation for a long-term success. In the end, charts are more than lines and candles. They are stories of human behavior, opportunity, and risk. A $100 trader who learns to read these stories carefully, patiently, and consistently gains an edge that is impossible to buy with money alone. By focusing on probability, respecting patterns, using indicators wisely, and combining this with solid risk management, you turn charts from a source of confusion into your greatest ally. Master the chart.